Hello and welcome to another session of the My Solo 401k Financial weekly YouTube webinar. We're just waiting for the viewers to log in and confirming the audio, and then we'll get started momentarily. So I see that the viewers appear to have logged in and we confirmed the audio is good. So we'll go ahead and get started. Today's session is a great topic. We're going to be going over a very popular topic, which is Mega Backdoor Roth Solo 401k conversion to a Roth IRA at Charles Schwab. We really appreciate you taking the time to join. Please like this video. Please subscribe for more videos like this. You will have access to the full recording on our My Community site, where you can also pose additional follow-up questions in our discussion forum. You'll be able to view these slides. You'll be able to view the full recording. So please join the community. It's free, and we can continue the conversation over there. Otherwise, we'll get started. As we're going through these slides, I please encourage you to ask questions, and I will answer the questions as we go through them. But what we're going to do is, again, talk about making Mega Backdoor Roth Solo 401k contributions to an account at Charles Schwab, and then converting those over to a Roth IRA at Charles Schwab. So we're going to start out with going over the steps at a high level, and then we're going to dig deeper into a lot of these steps to really explain how things work. So the first step in the process is going to be to open a solo 401k. So that means, of course, you need to be eligible to do so. So you have to be self-employed, meaning you're reporting earned self-employment income on your taxes and have no full-time W-2 employees working for you. You then need to find a solo 401k provider. So in order to make Mega Backdoor Roth contributions, you really need to go to a specialty solo 401k provider like My Solo 401k Financial that offers an IRS approved plan that allows you to make those Mega Backdoor Roth contributions, and that also will handle the ongoing compliance support, whether that's helping you to determine how much you can contribute, how to report it, as well as handling the required 1099-R reporting as part of their services for no additional charge, like My Solo 401k Financial, like we do. So once you've confirmed that you're eligible, you found the provider, you go ahead and adopt the solo 401k plan. So the provider, we will draft the solo 401k plan documents for your signature. Step 3, an employer identification number needs to be obtained, which is specifically for the plan. So that's obtained from the IRS, and that meets the IRS's regulatory expectations. They made it clear on their website that the expectation that is that an EIN is obtained for a 401k plan, and that lets the IRS know that that EIN is associated with the 401k. Next, it's time to open the brokerage account at Schwab. So we prepare the brokerage account forms as part of our service for no additional charge. We pre-fill those out. We provide you a link to our secure website where you can download those pre-filled forms. You sign the forms, you upload them back to our secure website so that we can review and compile them to ensure they're in good order, and so that the forms can be faxed over to the back office at Schwab. Schwab will then take approximately 5 to 7 days to open the new account or accounts. So it's important to understand that Schwab is not the plan provider. We are. They're simply the custodian of the funds. And you are the only one that has access. In other words, we don't have access. You have access as the trustee of the plan. In terms of the number of accounts, it really is going to depend on whether or not you're going to use all the accounts and how many participants there are. So let's start with a simple example. You might have one person that's self-employed, and let's say you are going to make the Mega Backdoor Roth contributions and then transfer over to a Roth IRA. And we are going to go through slides towards the end of this presentation that really illustrate this account structure. But in that scenario, you will need at least one voluntary after-tax account in order to make those Mega Backdoor Roth contributions. Now, if you're also going to be transferring pre-tax money into the plan, like let's say you have pre-tax money that's in a former employer plan and you want to roll it over, then you'll need a pre-tax account. If you also are going to make Roth contributions, or if you're going to roll over Roth funds, then you would need a Roth account. So we have a lot of individuals that have 3 accounts at Schwab. And then if there's 2 participants, let's say it's a husband and wife, then they've got 6 accounts. And as part of that establishment process with us, we take it to a page on our website where we determine and help you decide how many accounts you need, and you communicate with us so we can prepare all the paperwork that you'll need to open up all the accounts. But if you're doing the Mega Backdoor Roth to Roth IRA at Schwab, you at least need 1 account at Schwab, which is the after-tax account for each person. Once the money's in that after-tax brokerage account at Schwab for your 401k, it's time to process the conversion. So in this scenario, here the money is being transferred over to a Roth IRA, as opposed to keeping it into the Roth, in the solo 401k and transferring it to the Roth solo 401k. So it's going out of the Roth, it's going out of the 401k, out of the after-tax account, over to a Roth IRA account. So you're converting the voluntary after-tax solo 401k funds to a Roth IRA, not the solo 401k. And in this scenario, we're assuming that you were going over to a Roth IRA at Schwab. So continuing with the process to convert those funds, Schwab's form would be used to process and direct an internal conversion of the solo 401k voluntary after-tax funds to the Schwab Roth IRA. The conversion form can be submitted to Schwab by fax or by upload. And then that conversion needs to be reported. So after the conversion has been processed, in other words, the voluntary after-tax solo 401k funds have been moved to the Roth IRA, you need to let us know the information that we need to report the conversion. So we, My Solo 401k Financial, not Schwab, reports the conversion by issuing a Form 1099-R. And we have a form, an online form on our website, the after-tax solo 401k to Roth IRA online conversion form. And if you go to our website in the upper right corner, you'll see a link to the forms page where you can access this form. You complete it, you let us know the information that's needed so that we can issue the Form 1099-R to report the non-taxable conversion to the Roth IRA. So let's go through some examples. Like I mentioned, we wanted to go through some illustrative examples to help illustrate how this works. So in example number 1, we have 1 participant who's converting voluntary after-tax solo 401k funds to a Schwab Roth IRA. So here you can see the individual has 3 different accounts. So XYZ Trust for the benefit of Jane Doe, pre-tax. XYZ Trust for the benefit of Jane Doe, Roth. And then lastly, XYZ Trust for the benefit of Jane Doe, after tax. So the contributions are made into the after-tax account and then converted to the Roth IRA, the Jane Doe Roth IRA at Schwab. In example number 2, let's say it's a husband and wife. So same thing for Jane Doe. So participant number 1 converts her voluntary after-tax solo 401k account to a Roth IRA at Schwab. And then participant number 2, John Doe, he's got the same structure. So he's got the XYZ Trust for the benefit of John Doe, pre-tax, Roth, and then voluntary after-tax. So an additional 3 accounts for a total of 6 across the whole plan. And just like Jane, he makes that contribution into his after-tax solo 401k sub-account, and then the funds are converted over to the Roth IRA at Schwab. So before we go into the next set of slides in this presentation, again, I would encourage you to like this video. Please subscribe. If you have questions that are coming up, don't hesitate to chat them over through the YouTube chat function, and we will field the questions as we go through. So in terms of the benefits, right, one of the benefits here is that you're really able to contribute a large amount of funds relatively into a Roth account, specifically a Roth IRA. So, and we'll go through some examples, some scenarios, so you can see how the math works. But you can contribute up to $57,000 or even 63,500 if you're 50 or older to a Roth solo 401k for 2020, or 58,000 or 64.5 if you're 50 or older for 2021. Now for 2020, you would have need to have set up the plan on or before December 31st, 2020. And then again, you have to have a plan that is going to allow you to do that, to make these types of contributions. So you could always restate, there's still time to restate over to a plan like our plan that does. So like if you had set up a quote unquote free plan at Schwab that doesn't allow you to make the voluntary after-tax contributions, you set it up before December 31st, 2020, you can restate with our plan and still make these contributions. You got the money now, you know, it goes like in our examples over to that Roth IRA. So now you have the potential for tax-free growth. So again, to dig a little deeper, like we talked about the steps at a high level. Let's dig a little deeper in terms of how it all works. So again, you got to be self-employed. That's the threshold, right? You need to be able to qualify. A 401k, specifically a solo 401k, is for a self-employed individual with no full-time W-2 employees working for any business owned by that person or a spouse. You need to have a provider that allows for the voluntary after-tax contributions and the in-service distributions. That's the conversion or the rollover, like in this case to the Roth IRA. And you want to work with a provider that, you know, it's going to help you set up the required sub-accounts, and it's going to provide the ongoing compliance support. Like we prepare the 1099-R for no additional charge as part of our service. Now let's turn to how much can I contribute? So the solo 401k contribution limits are based on different factors. One factor is your age. Another factor is what's your self-employment income, because you can't save more than you earn, and you have to have, it has to be based on your self-employment income. In other words, if you have a W-2 job and then you have a side business that's for which you have the solo 401k, you can't take your W-2 wages that you earn at your W-2 job and use that to justify contributions to the solo 401k. So it's really limited to that self-employment income. It's also, you know, whether you participate in another plan, like a 401k plan through your quote unquote day job, the type of contribution. So there's sub limits. So whether we're talking about employee or employer, pre-tax, Roth, or voluntary after tax. And if you're also looking to make other, I know today's presentation, we're really focused on the after tax to Roth IRA. But some individuals, they have other objectives that they want to achieve. Like they still want to make some pre-tax contributions before they turn to the after tax. So we have a wealth of information on our website. So if you go to our website and you search for the word guides, there's going to be a result there that will take you to our contribution guides page, which is organized by how your business is taxed and gives a wealth of information. We've got slides, we've got presentations like this one, where we really go through how much you can contribute. So that would be a great resource for you. Now, in determining what your self-employment income is, the starting consideration is how is your business taxed? So for a business that's taxed as an S Corp, right? Whether that's an LLC taxed as an S Corp or a corporation taxed as an S Corp, your ability to make solo 401k contributions is based on the W-2 wages that you receive from the business that's taxed as an S Corp. And again, we're not going to consider W-2 wages from other sources like a day job. You also can't consider the profit that you make from the S Corp. So when you're self-employed, you know, you really have two roles. You're the employee, you're also the owner. So your 401k plans are for employees to make contributions, not for owners. So your ability to contribute is going to be the compensation, in other words, the W-2 wages that you receive as an employee. Now, if your business is taxed as a single member LLC or a sole proprietor, right? Like let's say you're getting a 1099 miscellaneous or NEC as an independent contractor. Let's say you're a realtor and you're reporting that income on your 1040 on Schedule C, your ability to make solo 401k contributions is going to be based on your net income. In other words, what's on line 31 of Schedule C. And then you have to do a pre-calculation. So you have to reduce that net income by 1/2 of the self-employment tax to give you your self-employment compensation. And just like with the S Corp scenario, you know, you're not going to be able to consider W-2 wages from other sources. So it's net profit, use line 31 of Schedule C, less 1/2 of the self-employment tax. And then lastly, if your self-employed business is organized as a partnership, where your business is filing a 1065 and you as an owner of the company are receiving a K1, you would look to line 14 of the K1. And just like with the Schedule C business, you then have to do a pre-calculation where you reduce that line 14 of the K1 by 1/2 of the self-employment tax. And just like with the other examples, you can't consider W-2 wages from other sources like a day job. You can't consider the investment income. It really has to be that earned self-employment income to justify the contribution. Now, in terms of the different types, I mean, we can preview this quickly. Again, we're focused on the after-tax to Roth IRA scenario today. But just to touch on it quickly, in terms of the employee contribution, here the limit is 100% of your self-employment compensation. So whether that's W-2, if you're an S Corp, or line 31 is Schedule C less 1/2 of the self-employment tax if you receive if you're self-employed as a sole proprietor, an unincorporated business. Whatever that self-employment compensation figure is, you can contribute 100% as an employee, as a quote-unquote salary deferral, up to $19,500, plus an additional $6,500 if you're 50 or older. And that's both for 2020, if you had set up the plan before December 31st of 2020, or if you're just setting it up now for 2021, the limit stayed the same. And you do have to reduce it by any contributions that you make to a day job. So if you're participating in another plan, like through a day job, and you max it out at the day job, you can't make any more employee contributions to the solo. Now that employee contribution can be made as a pre-tax contribution, in which case it would go into that separate pre-tax account, or as a Roth, in which case it would go into the Roth, but not the after-tax. And that's the point of this slide here, is just to note that that 19.5, if assuming you can justify it, you're not making contributions to another plan, you could put it all in as a Roth, but it would go into the Roth solo 401k, and you wouldn't be able to transfer it automatically over to the Roth IRA like you can with the after-tax contribution. The second type of contribution that we're going to go through quickly again is the employer contribution. Now, employer contributions are always pre-tax. So the employer contributions cannot be made as after-tax or Roth. And just like with, how your self-employment compensation is figured, the contribution rate depends on how your business is taxed. So if your business is taxed as an S corporation, your ability to contribute is based off of the W-2 wages that you receive from your self-employed business taxed as an S corporation. And the employer contribution limit is 25% of your W-2 wages. And that begs the question, well, what is W-2 wages exactly? So you use box 1 of the W-2 plus any pre-tax elected deferrals not in box 1. And of course, keep in mind, that we want to be cognizant of that overall limit. So for example, for 2021, that's $58,000 or $64,500 if you're 50 or older. And what's interesting here is that employer contributions are not impacted or reduced by contributions that you make to a day job. So even if you maxed out to your day job, you could still make that employer contribution to the solo if you got that self-employment income to justify it. Now, if your business is taxed as a single member LLC, where you're using or a sole proprietor, where you're using net income off of line 31 as Schedule C, again, you got to first do that pre-calculation. So line 31 less 1/2 of the self-employment tax. And then you can contribute 20% of that number as the employer contribution. Likewise with a partnership, you're going to take line 14 of the K1 less 1/2 of the self-employment tax to figure out your self-employment compensation. And then of that number, you can contribute 20% as an employer contribution. And just like with the other types of businesses, it's not impacted by contributions that you make as an employee to another plan, like a 401k plan at a day job. Okay, great. So that, again, we've got a wealth of resources. If that's really your goal, is to also make those pre-tax contributions. Here, again, we're focusing on a scenario where someone is making voluntary after-tax contributions and then converting it over to a Roth IRA, taking it out of the plan. So let's talk about that voluntary after-tax contribution limit. So the limit is the lesser of your self-employment compensation. Again, you can't contribute more than you earn. So it's the lesser of whatever that is, or the overall limit, which for 2020 is $57,000. For 2021, it's 58,000. So it went up a little bit. Now it's reduced by any employee or employer contributions that you make to the solo 401k. Not you're ignoring catch-up contributions that you make to the solo though. So if let's say you have the self-employment income to justify a $58,000 contribution, but you also did a $10,000 employer contribution, the most that you can contribute as an after-tax is going to be $48,000. Note the limit does not go up if you're 50 or older. So that overall limit is not going up. We've got some good examples to really hammer home this point. But even if you're 50 or older, you're not going to be able to contribute more than the $58,000 as a voluntary after-tax contributions. Another good point, it's not impacted by contributions that you made to another retirement plan through an unrelated employer, so the day job 401k plan, unless the other plan is a 403b. So then we've also got how voluntary after-tax contributions need to be deposited into a separate sub-account for each participant. And we saw that with our illustrative examples about how there are different sub-accounts, right? You might have 6 accounts. You've got 2 people and they're all making, each person's making pre-tax, Roth, and voluntary after-tax contributions. So let's now turn to the scenarios. I think that's going to be really helpful to help illustrate. So with our first scenario, it's a 1 participant scenario. The individual is under 50 years of age, and their goal is to maximize after-tax contributions in order to convert to a Roth IRA. So let's assume that the individual has $100,000 of self-employment compensation. That could be $100,000 of W-2 wages from their business that's taxed as an S corp, or it could be $100,000 of self-employment compensation, after they've taken line 31 of Schedule C, less 1/2 of the self-employment tax, or line 14 of the K-1 if their business is taxed as a partnership, again, less 1/2 of the self-employment tax. So for all scenarios, let's say they have that $100,000 of self-employment compensation. And again, their goal here is to maximize the money that goes over to the Roth IRA at Schwab. So that means that this person doesn't want to make any employee contributions, doesn't want to make any employer contributions, and just wants to focus on the voluntary after-tax contribution. So that person can contribute dollar for dollar up to $57,000 for 2020 or $58,000 for 2021. Because remember, the voluntary after-tax contribution limit is the lesser of self-employment compensation or the overall limit. Here, the person has $100,000 of self-employment compensation. So they can contribute dollar for dollar up to the overall limit, $58,000, for example, for 2021. And they haven't made any contributions as employee or employer contributions to the solo 401k. So they can put it all in as an after-tax and then convert it over to a Roth IRA at Schwab. Now, to illustrate the point about the person being 50 years or older. So same scenario, they want to maximize the money going to the Roth IRA. They got $100,000 of self-employment compensation, but now let's say they're over 50. Again, don't put anything in as an employee, don't put anything as an employer. Put it all in now as a voluntary after-tax, which they can do because they can go dollar for dollar up to the overall limit, and their self-employment compensation is over $58,000. But here, the point that we're illustrating is that that limit is not going up just because they're 50 or older. So all they're going to still be able to do as an after-tax contribution is the $58,000 for 2021. Now let's look at a two-person scenario. So let's say it's 2 spouses or 2 business partners. Each is under 50 years of age. Again, same goal, maximize the after-tax in order to convert to a Roth IRA. And each person has $100,000 of self-employment compensation. So same scenario for each person. They could decline to make employee, decline to make employer, put it all in as a voluntary after-tax in order to convert it over to the Roth IRA. And each person can do that. So in this scenario, the 2 individuals have each put in $58,000. So that's like almost 120. That's about 116,000 between the 2. So let's go into another scenario. Here we're going to change up the scenario a little bit. So we're back to a one participant under 50 years of age. Again, the goal, like all goals here, is to maximize the money going in as an after tax so that it can be converted over to the Roth IRA. And they have $100,000 of self-employment compensation. But now let's put a twist on it and say, well, they put in $19,500 to their day job plan. How does that impact it? It doesn't. So again, here we're illustrating the point that the voluntary after-tax contribution is not reduced by contributions made to another unrelated employer's plan. So they could, again, decline to make employee. They wouldn't even be able to because they already maxed out to their day job. They could choose not to make employer because here the goal is to maximize the money going in as an after-tax contribution and put it all in because they've got the self-employment income to justify it. Put it all in, say it's $58,000 for 2021 in order to convert it over to a Roth IRA. Now let's talk about more of the mechanics. How do I make the contribution? So of course you can make the contribution by writing a check payable in the name of the solo 401k. You know, it's good practice to write annual contribution in the memo section. You could also do an electronic transfer. You want to check with the financial institution that holds the accounts. Other than Fidelity, most brokerage firms don't allow for electronic deposits from an external account where the external account doesn't match the name. In other words, it's not an external account in the name of the plan, which of course it wouldn't be if you're making a contribution. Each person deposits his or her contributions into separate sub-accounts. So again, pre-tax goes into pre-tax, Roth goes into Roth, after-tax goes into a third after-tax account. If all you're making is after-tax contributions though, and you don't have pre-tax money that you're contributing or rolling over, you don't have Roth money that you're contributing or rolling over, you could choose just to have an after-tax account for the solo 401k. So what is the deadline, or when is the deadline to make contributions? So the deadline to make all types of contributions, employee, employer, voluntary after tax, is driven by the business tax return deadline. So if your business is a sole proprietor where you're reporting your self-employment income on your 1040, it's your 1040 deadline. So, you know, April 15th or October 15th if you file a timely extension. If your business is taxed as an S corp, then it's going to be driven by the S corp deadline, March 15th or September 15th, if you file the timely extension. Now that assumes that you set up the plan on or before the end of the year for which you want to make the contribution. So if you're trying to make the contributions for 2020, like we talked about earlier, you would have had to have set up the plan, established the plan on or before December 31st, 2020. And of course, if you set up the plan here in 2021, now you've preserved the right to make those contributions up until your business tax return deadline in 2022, including any timely filed extension. And all of this is clear based on IRS publication 560. There's a chart on page 3 which confirms it. And again, I would encourage you, if you have questions as we're going through, please don't hesitate to ask. So let's talk about, how do I report contributions now? So again, we're focused on the voluntary after tax for today's session, but if we have a wealth of information, because we know some individuals have multiple goals they want to achieve. So here we have listed, you know, if your business is taxed as an S corporation, the voluntary after tax contributions may be reported on box 14 of the W-2, but it's not necessary, it's optional. Now, if other types of contributions, they've got to be reported on the W-2, or employer contributions go on your S corporation tax return. Now, if your business is taxed as a sole proprietor, independent contractor, voluntary after-tax contributions are not reported. There's no place to report it on the 1040. Partnership, it's the same situation. So if again, the focus is voluntary after-tax contributions, there's no place to report it if your business is taxed as a partnership. Now, other types of contributions, right, pre-tax, of course there is. You want to get that credit so you can reduce your taxable income. And again, if that's part of your objective, please check out the other resources on our website. Now you've made that contribution. It's within the limit, it's by the deadline, it's in the right account, right? It's in that separate voluntary after-tax account. Is there a deadline to convert? No, there is not. There is no deadline to convert the voluntary after-tax funds over to the Roth IRA. So you could do it shortly after, or you could wait. It's up to you. Of course, if you have gains inside that account, those gains are going to be taxable. Now, the conversion is reportable for the year of the conversion. So this is a common question, right? People might be making contributions for 2020 even now because they set up the plan before December 31st, 2020. They filed a timely extension for the business tax return. So now they have up until the extended deadline of their business tax return to make those 2020 contributions. So the contributions are reported for their 2020 tax return, but the conversion happened in 2021. So the conversion is going to be reported on the 2021 1099-R. So for example, you make the voluntary after-tax contributions for 2020 in 2021, but you convert the funds, so it'll be issued, like I said, for 2020. It'll be a 2021 1099-R, which is issued in 2022. Hopefully that helps. So in terms of that tax reporting, you've got, of course, the amount converted, including any gains. It's for the year of the conversion. It's going to go on the 1040 on line 5A, and any gains, if any, there might not be any, would be on line 5B. Again, we have a form on our website where you can give us the information that we need in order to prepare that 1099-R as part of our service. So this is the move again from the voluntary after-tax account over to the Roth IRA. And we have that specific form for that Roth IRA conversion as opposed to the Roth Solo 401k, which is a different online form. So that takes us to the end of the slides. If you're, please continue the conversation on our forums. You can go to mysolo401k.net/my community/forums, and you can join for free and post questions. We'll have a specific forum set up for today's webinar, but then you could also just post free forum in the general forum section as well. We do weekly webinars almost every day of the week in the community to continue the education and discussion there. So it's a great opportunity to learn. So please don't hesitate to ask questions. But we really appreciate everyone taking the time to join and watch. And please don't hesitate to ask follow-up questions in the forums. And we look forward to continuing it. Thank you so much.